Welcome to video 3 of part 2 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here, back with you to discuss assets and depreciation. How to depreciate property and handle the sale of assets is the same across all entity types. So, what we'll discuss here applies whether you're dealing with a sole proprietorship or a multinational corporation. Before we begin, though, I strongly recommend that you watch part 1, video 3, which covered capital gains. If you have not watched that, I would really recommend that you go back and watch that video before you watch this one. Or if it's been a while since you watched it, you might want to go back and refresh yourself on it. If you've watched it recently, then you are probably okay. We are going to cover some of the things that we covered in that video, but we'll do it much more briefly than we did then. And there will be some things that we just don't cover in this video that I'm going to assume that you know from having watched that video. So it is important that you have a good understanding of that information. That was in part 1, individual taxation, because a lot of the same concepts can be tested there and or in part 2. So I wanted to make sure I covered it in part 1, but you're going to need some of that information for part 2 as well. So with that out of the way, what we will study in this video is first the basis of business assets, then depreciation and amortization, and then the sale or disposition of business assets. As always, we have free resources, and as you can see, it's a short list for this video, but both of these are important. I would recommend you get both of these publications from irs.gov. IRS Publication 946, How to Depreciate Property, and IRS Publication 544, Sales and Other Dispositions of Assets. So let's start with the basis of business assets. So the basis of an asset generally starts with its cost. So it is easiest incarnation. Basis is equal to cost. And cost includes other items other than just the pure purchase price of whatever you are buying. It would include any sales tax that you paid, or shipping costs that were included, or installation fees that you paid, or things like recording fees or assumption of liabilities. So if, in other words, if the company assumed a debt on the asset that they were purchasing, then that amount that they assumed would be included in the basis of the asset. When we're talking about real property specifically, and remember, real property is like buildings and land, think about real estate. It usually is going to include costs other than the purchase price, and those will be found on the closing statement. If you've ever bought a house, then you are familiar with the closing statement. It's got lots of things listed on there. And so you'll see some closing or settlement costs, such as recording fees, appraisal fees, abstract fees, survey costs, title insurance, etc. It does not include the loan fees or any fees or points, anything like that, that are related to the loan to purchase the property are not included in the basis of the property itself. But what will happen with those fees is you will capitalize those separately and then amortize them. So we will talk about that a little bit later in this video. Still talking about real property here. If you are constructing a building or real property rather than buying it, then all the expenses of construction are included in the basis of the property, including materials, labor, permit fees, inspection fees, etc. In other words, you cannot deduct those things immediately when you pay them. You have to include those costs in the basis of the property. And then if it is a depreciable asset, then you will depreciate that basis, including all of those costs, over the life of the property. If demolition is done prior to building whatever you're building, the demolition costs are added to the basis of the land rather than the new building. And that is important because, as we'll see, land is not depreciable. So we would rather the demolition costs be included in the basis of the building, because the building we're going to be able to at least depreciate and expense over time, Whereas when they are, because this is the rule, since they are included in the basis of the land, then we are not going to be able to deduct those costs, at least not until we sell the land. Basis increase after purchase. This can be for any kind of property, but it's more common with real property, but it's not always real property. If you make major improvements or additions to the property, your basis increases by the cost of those improvements or additions. So again, thinking mostly about real property here, if you add a room or a driveway or a fence or any of these types of major items, then those increase the basis of the asset. But this does not include repairs to those items. So do not increase basis for maintenance items such as painting, fixing leaks, filling holes and cracks, or replacing broken hardware. Instead, you actually get to expense those items, which is a better deal. We'd rather expense them all when they're incurred rather than having to add them to the basis and depreciate them. So there can be a lot of nuance here. It's not all black and white as to when do you include it in the basis and when do you deduct it. For purposes of the EA exam, you're not going to have to make a close call on something. They're not going to give you something that you think, well, maybe it's one way or the other. It's going to be obvious that you're either adding a room or building a new driveway or something like that. You would distinguish that from, for instance, filling holes in the driveway. If you're just filling a hole in an existing driveway, well, that's a maintenance item. You can deduct it. But if you're building a whole new driveway, then that is a capital item and you have to add that to the basis of the property. And when you look at the IRS publication on depreciation and amortization, it will give you more specifics on this as well. There are some safe harbor rules. So a safe harbor, anywhere in the code, you might see a safe harbor. And a safe harbor basically means if you meet certain criteria, then the IRS will not argue about it. Doesn't mean you have to meet that criteria in order to prevail. It just means if you do meet that criteria, you don't have to worry about the IRS disputing it in case of audit. So there are certain safe harbors that apply to, is it a repair or should it be added to the basis of the property? And so remember, as we're going through this, businesses would usually rather expense an item than capitalize it. Because if you expense it, you get to deduct it right away. If you capitalize it, then you have to deduct it over time, or maybe not even at all if it goes into land. So usually we'd rather expense an item than capitalize it from a tax standpoint. So the first safe harbor rule we'll talk about is the most common one. You will see this on lots and lots of business returns. If you are doing a business return, most of the time, you are going to be taking advantage of this safe harbor, and therefore you are going to want to attach a statement to the tax return that we're going to describe here. So if you purchase an item for $2,500 or less, for each item is $2,500 or less, then you can generally expense it, even if it is an item that usually you would have to capitalize. So let's say you're buying just a computer, a laptop computer. Normally, if you buy a laptop computer, that's an item that you would capitalize and depreciate. But if you pay less than $2,500 for that laptop, you can just go ahead and expense it. You don't have to worry about depreciating it. If you are a larger business that has an applicable financial statement, you'll sometimes see this phrase, applicable financial statement, so we might as well learn what it is. But if you are a business with an applicable financial statement, that $2,500 goes up to $5,000. So you have even fewer things that you have to depreciate, more things that you are allowed to deduct. However, an applicable financial statement is only for large businesses. So it's an audited financial statement or one required by the SEC. So a small business can have an audited financial statement, but usually that's going to be bigger businesses that actually have a full-blown audit of their financial statements. And then obviously, if you have a financial statement that's required by the Securities and Exchange Commission or some other government agency, then you are going to be a larger type of business. But that's what an applicable financial statement is. This safe harbor does not apply to inventory, land, or rotable, temporary, and standby emergency parts. And that's because those things are not depreciable to begin with, and they're usually going to be deductible in their own way. So, inventory, for instance, you will deduct inventory when you sell the item, whatever it is. Land, of course, is not depreciable at all, so you can't deduct that at all. Rotable, that's used a lot in the aviation industry. It's parts that you use for a while and you can reuse them several times, but eventually you're just going to throw them away. That's what a rotable part is. And then you could have temporary and standby emergency parts. So this $2,500 safe harbor election does not apply to those. You have to look at those specific types of assets and what are the rules for those in order to know how to handle them. This safe harbor, though, has to be elected each year by attaching a statement to the tax return. So every year when you're doing this. So if you got a business return, it's good practice just to attach this statement every single year, even if you don't think they purchased anything that year for $2,500 or less. Doesn't matter. Go ahead and attach the statement. And you will basically say this taxpayer is electing the section 1.263A-1F de minimis safe harbor election. And you can add a little bit more to it, but you can go out and do a search on the internet for exactly how to word this statement, but that statement needs to be attached every year that you want this safe harbor to be applicable. Other safe harbor rules, there's another one called the small taxpayer safe harbor election, and this one can be great. So this is for businesses that have gross receipts of $10 million or less, and the building that we're talking about, not including the land, just the building, must have an unadjusted basis of $1 million or less. So if you meet that criteria, then they can expense repairs rather than capitalize them, which is great. So as long as those repairs do not exceed the lesser of $10,000 or 2% of the unadjusted basis of the building. So if you've got a building and the unadjusted basis, and we'll talk about adjusted versus unadjusted later, but for now, just take it for what it is. The unadjusted basis of the building, not including the land, let's say is $100,000. Then you can expense repairs of $2,000 or less to that building because it's the lesser of $10,000 or 2%, and 2% of $100,000 is, of course, $2,000. If you had $1 million building, 2% of that would be $20,000. So then it would be limited to repairs of $10,000 or less. So it is the lesser of the $10,000 or the 2%. Next safe harbor is for materials and supplies that are not included in inventory. So materials and supplies purchased with an estimated useful life of 12 months or less can be expensed, and materials and supplies costing $200 or less can be expensed. And for this one, you don't need to attach anything to your tax return. So this is pretty standard. They're just letting you know if you're buying normal materials and supplies that are not included in inventory, you can just go ahead and expense those right away. And then they're specifically saying if it costs $200 or less, then you can expense it as well. Next safe harbor is called the remodel refresh safe harbor. So if you have qualified expenses paid to remodel or refresh a qualified building, then 75% of those expenses can be expensed, and then 25% need to be capitalized and included in the basis of the building. And this one does not apply to businesses with an applicable financial statement. So it's only for smaller businesses. Now you see there, qualified expenses, qualified building, remodel, refresh. You might be asking, what exactly is a qualified expense? What is exactly a qualified building? What does it remodel? What does it refresh? So for the EA exam, you don't need to know all of that detail. What you need to know is there is something called the remodel refresh safe harbor, and that as long as it's qualified, then 75% is expensed, 25% is capitalized. And if you want the details of that, then you can do further research, but you don't need that for the EA exam. a little bit more about the basis of assets. Adjustments to basis. Over time, your basis in an asset can increase or decrease. So increases, as we've already talked about, are usually due to improvements that are made to the property. Decreases, the most common type of decrease to the basis of an asset is depreciation deduction. So when you take depreciation deduction on your tax return for an asset, that decreases the basis of that asset. Now, this can also happen from other things, such as insurance proceeds from a casualty loss. So let's say you've got a building and there's a storm or other covered event, and your insurance pays out, then that will reduce the basis of that asset. Of course, if you then go ahead and make whatever the repairs are, then that would again increase the basis because now you're spending money on it. So it could be a wash. You get the insurance proceeds, that decreases the basis, you make the repairs, that increases the basis, and you end up right back at or near where you were before. But sometimes you might take the insurance money and not make the repairs, and in that case, that would just simply decrease the basis of that asset. Also, rebates received and other special items could reduce the basis. So let's say you bought something and you paid a certain amount for it, and then after you bought it, you got a rebate from whoever sold it to you or from the manufacturer. So that rebate is sort of like a reduction in the sales price. So it's a reduction in the cost. So that would be a reduction in the basis of the asset. So the basis of an asset that has had these increases or decreases is called its adjusted basis. So when you hear about adjusted basis or unadjusted basis, sometimes, for instance, we talked about that safe harbor and it said the unadjusted basis of the building had to be $1 million or less. So what that means is you look at basically the original cost of the building before you took any depreciation expense or had any other reductions. If the unadjusted basis is $1 million, then that applies. Other parts of the tax law will talk about the adjusted basis, and they'll say this depends on the adjusted basis of the asset. So that's why you need to understand the difference between adjusted and unadjusted basis. Converting an asset from personal use to business use. So this happens quite frequently, especially in small businesses. You might convert property from being just a personal asset to using it in your business. If you do that, the basis of that asset is the lesser, it's the lower of these two things: the fair market value of the property at the date of the conversion, or the adjusted basis of the property, the original cost plus or minus adjustments. So let's say you've got a computer that you're using personally, and then you start a business, and now you're saying, I'm going to now use this computer in my business. Probably that computer is worth less now than it was when you paid for it. And since it was a personal asset before, you weren't taking any depreciation or anything on it. So the basis of that property is likely higher than its current fair market value. So your basis for tax purposes would be the fair market value of that property. On the other hand, you could have a building that you've been using it for personal use, but now you're going to convert it to business use. That building might be worth more now than it was when you bought it. So in that case, you would use the basis of the property instead of the fair market value of the property. So it's the lower of those two things. So now depreciation and amortization. We've already been talking a little bit about these, but we haven't actually defined them or explained them. So let's talk about these two things. Depreciation. Depreciation is how a business expenses the purchase or production. It's easier to think about it from a purchase standpoint. So the purchase of a tangible asset. Tangible meaning something you can touch: building, vehicle, machinery, computer, desk, etc. Other than inventory. So we don't depreciate inventory. So items that we are buying in order to sell to our customers, we don't depreciate those. But other than that, any of these other tangible assets that are used in the business and expected to last more than 1 year. So if you have an asset that is expected to last less than a year, you can just go ahead and expense it right away. You don't have to worry about depreciation. But if it's expected that that asset is going to last more than 1 year, then you cannot expense it all in the year that you purchase it. Generally, we'll talk about some exceptions later, but we're talking general rules about depreciation here. So you can't deduct it all in the year that you purchase it. Instead, you have to spread out the expense of buying that item over its anticipated useful life. So you get to deduct it. It's just that you can't deduct it all in 1 year. You have to deduct it over several years of its expected useful life. So that's what depreciation is. Now, it can also be thought of, and outside of a tax or accounting standpoint, you may have thought of it as this way, and that is it is a deduction for the wear and tear and obsolescence or other loss of value of the asset. So this is the classic, you buy a new car, as soon as you drive it off the lot, it's already lost a certain percentage of its value. That's depreciation. And of course, 5 years later, that car has lost a lot of its value because it's got lots of miles on it and wear and tear and dings in the door and et cetera and so forth. So you can think of depreciation, if you'd like, as a deduction to account for that wear and tear. But I think it's easier just to think of it as it's how you are expensing that item. Instead of expensing it all in 1 year, you are expensing it out over several years. Land is one big exception to depreciation. Land is not depreciable because its expected useful life is forever. Now, it may not be. You can talk about erosion or whatever, but we expect that land is going to last, quote unquote, forever. So if we think of depreciating an asset over its expected useful life, and the expected useful life is forever, well, that's a problem. And so no depreciation is allowed for land. That's why before, when we said that if you have demolition costs, it's included in the value of the land rather than building, we were kind of bummed out about that because that means we're not going to be able to depreciate those costs. Amortization is what we call depreciation when the asset is not tangible. So you have assets that are called intangible assets, such as patents that have been purchased, copyrights, software is an intangible asset, something called goodwill is an intangible asset, and there are others. But for those, we don't call it depreciation. We call it amortization, but it's the same idea. We don't deduct the cost of those all in the year that we pay for it. We spread that cost out over time, and we will get more into the specifics of that coming up. Depreciation and amortization are reported on Form 4562. So if you do business tax returns, you will become very familiar with Form 4562. And you use the same form, whether you're talking about a sole proprietorship, a partnership, a C Corp, or an S Corp. It's all done on 4562. And you don't necessarily have to do a 4562 every single year. Now, if you buy new equipment that you are depreciating, you are going to have to do the 4562. But if you haven't bought anything or sold anything in the past year, there's a good chance you don't even have to do a 4562. You still take a depreciation deduction. You just wouldn't have a Form 4562 that goes with it. So you would look at the form instructions to see that. Depreciation. When we record depreciation expense, now I'm going to get all accounting on you here for a minute again, okay? When we record depreciation expense, we simultaneously record accumulated depreciation, which is called a contra asset account, and it shows up on the balance sheet as a subtraction to fixed assets. So remember when we talked about double entry accounting, and we said every transaction has to have two offsetting entries. So the offsetting entries for recording depreciation is we would do a debit to depreciation expense, and we would do a credit to accumulated depreciation. Of course, there would be dollar amounts associated with that. That's all I'm going to say here. I'm saying that because it is possible that you could have a debit and credit question on the exam related to this. I said before in our last video that you're probably only going to have one or two debit and credit questions on the whole exam, and this could be one of them. So even if you don't really understand debits and credits, if you can just remember that depreciation expense, you debit depreciation expense, you credit accumulated depreciation, that might help you to answer a question on the exam. And again, I will refer you to this other video that is on the EA Tax Training YouTube page, an easy way to remember debits and credits. It's about a 29-minute video, and it will explain what debits and credits are all about and how we think about them. So watch that video if you want to know more. What information do you need to compute depreciation expense? Well, you need the basis of the asset. You need to know its useful life or recovery period. You need to know the method of depreciation that you're going to use. And you need to know something called a convention, which we will talk about. Now, note, for tax depreciation, we do not assign a salvage value to the asset. If you've ever taken an accounting class, you've learned how to do various methods of depreciation, and they will always start by having you subtract the salvage value from the basis of the asset before you compute your depreciation. But in the tax law, we don't do that. So it's actually easier and it's actually better. It gives you more depreciation than you would otherwise have. But just know no salvage value when it comes to tax depreciation. Now, we talk here about the useful life or recovery period in just financial accounting, generally accepted accounting principles. Not only would you have salvage value, but your useful life would be more, I guess, subjective. So you could use as a business any reasonable useful life that you thought applied to that particular asset. So you would make your best kind of estimate of what a useful life would be for a particular asset. In the tax law, the IRS doesn't want taxpayers deciding for themselves what the useful life is and therefore how much the depreciation is. Otherwise, taxpayers would just decide that everything had a useful life of 12 months or less, and they would just depreciate and expense the whole thing in the first year. So instead, the IRS tells you what you need to use for the useful life, or actually they'll call it the recovery period. So it's the same concept, except what they're saying is we don't actually care how long the asset might last. We're just telling you from a tax standpoint, this is the number of years over which you can depreciate that asset. This is the recovery period. So here is the chart with all the different types of assets. So we'll try to zoom in here and look at it a little more closely. So you can see you've got these are your different, what they call property classes. So these are the recovery periods: 3 year, 5 year, 7 year, 10 year, 15, 20, 25, 27 and a half, and 39-year property. And then it tells you within each of those classes what is included. So you can see right here all the things that are included. So you would look down for whatever your asset is, and you would see here. Now I want to focus in on this. This is 7-year property, and notice what it says. Any property that does not have a class life and is not part of any other class. So in other words, 7 years is kind of the default if you don't fit into any of the other ones. So if you look through all this chart and you say, oh, I don't see my asset. I don't see it here. So what do? You use a 7-year recovery period. That is where it is included. This table, by the way, is right out of that depreciation publication that was listed at the start of the video. Depreciation methods. So now we know our recovery period. What is the method that we are going to use? Well, there are several different methods. The three that we are concerned with here, because these are the three that are potentially used in the tax law. First is straight line. So this might be, when you think of depreciation, straight line is probably what you think of in your head. So you just divide the cost over the useful life, and take an equal amount each year. So if you had a $10,000 asset that's got a 5-year life, you'd take $2,000 each year. That would be straight line. That's the simplest and most straightforward. And there are some assets in tax law that we use straight line for. Then there is something called double declining balance. I'm not going to go into the whole calculation, but what this does is it gives you higher depreciation in the first years compared to straight line. So it is an example of an accelerated depreciation method. Then you've got 150% declining balance, which is similar to double declining balance, except that it is a little bit less accelerated. So it's higher depreciation in the first years compared to straight line, but less than double declining balance. So you do not have to know how to calculate these for the exam. There's not going to be a question where they make you compute double declining balance depreciation. Okay, they don't have you do that. So just so you know, we'll talk later how you do figure out the depreciation. The depreciation method that is used for tax purposes is called Modified Accelerated Cost Recovery System, or MACRS. As you might guess, it started out as acres, and then they made changes to it. So they changed it to MACRS because it was modified. So it uses different methods for different categories of assets. Any asset with a recovery period of 10 years or less uses double declining balance. So that's good. Double declining balance gives you more depreciation in the early years compared to straight line. So that's good. We get the deduction sooner, which we like when it comes to income taxes, because that lowers our taxable income. So we like that. 15 and 20-year property also uses an accelerated method, but not quite as accelerated. It uses the 150% declining balance. And then most other properties, so the longer lived assets, will use straight line. The good news is, remember I said you weren't going to have to compute it. There are tables with percentages, so you don't have to do the computations. And so we will look at a couple of those tables today just to give you an idea of what they look like. But first, we need to next talk about the convention. Remember, this is one of the things we need to know is the convention. So a convention, it assumes a point during the tax year when the property was placed in service or disposed of for purposes of computing depreciation. For example, a half year, or sometimes called a mid-year convention, assumes the property was placed in service on July 1st for a calendar year taxpayer. So whenever you happen to buy it during the year, if you're using this half-year convention, then the amount of depreciation you get is going to be based on this mid-year that you placed it in service on July 1st of the year if you're a calendar year taxpayer. There can be other conventions as well that we'll talk about on the next slide. The reason we use conventions is to prevent distortion of depreciation expense. So, for example, taxpayers might purchase a lot of assets at the end of the year and want to or try to take a full year's worth of depreciation expense. So they're trying to keep taxpayers and accountants from getting fancy, buying all of their assets in December and then getting a full year's worth of depreciation, even though they didn't actually buy it until the last month of the year. So conventions are in place in order to prevent that type of game playing. So these are the conventions we deal with in the tax law: mid-month, mid-quarter, and half-year. So mid-month, this is used for non-residential real property, residential rental property, and any railroad grading or tunnel bore. So it assumes that an asset was placed in service in the middle of the month in which it was purchased. So if it was purchased in December, it will assume it was purchased on December 15th, essentially. If it was purchased in February, it will assume it was purchased February 14th. So that's the mid-month convention. The mid-quarter convention, it assumes it was placed in service in the middle of the quarter. And it is used if more than 40% of all property placed in service during the year was placed in service in the last 3 months of the year. So if we have that example where somebody bought everything in December, then they would be forced into this mid-quarter convention, because obviously if they bought all of it in December, then more than 40% of it was purchased during the last 3 months of the year. And so that would assume that it was placed in service in the middle of the fourth quarter. Half-year convention is what we already talked about. And this applies to any property that is not mid-month or mid-quarter. It's half year. So most property uses a half-year convention. So most personal property does. And some real property also uses half year. So it assumes that it is placed in service in the middle of the year. So now let's look at a couple of those charts that we talked about. And there are several of these based on all the different conventions and the different types of assets that are in the IRS publication that we referenced earlier. So here's one of those charts. This is for 3, 5, 7, 10, 15, and 20-year property with a half-year convention. So what this shows you is, for the year that you're computing the depreciation, then depending which class it's in, you will simply go and say, okay, it's 7-year property. This is our first year. I'll take the purchase price. Let's say it was $10,000. I'll take the purchase price times 14.29%. That will be my depreciation in year 1. Year 2, I'll take that $10,000 again times 24.49%, and year 3, etc. Now notice on this chart, this is called 3-year property, but there's actually 4 years that you're going to take depreciation expense. 5-year property, there's 6, 7-year property, there's 8, etc. Why is that? It's because of this half-year convention. So in the first year, you're not getting to take a full year. So it's going to spread it out into a 4th year, and for the 5-year into a 6th year, etc. So now another chart to look at is this one for residential rental property. So you can see here the month placed in service, because this is a mid-month convention. So this is, if this were a calendar year business, then this would be January, February, March, etc., but may not be a calendar year. So if it's, say, a June 30th year end, then month 1 is July, then August, September, etc. So whichever month that property was placed in service, whichever month of your tax year, you use that column. And then if this is the first year, so let's say this is the first year and you bought it in April, so you would take the cost times 2.576%. And then in years 2 through 9, they're all the same, 3.636%, and so on and so forth. And notice here, this is 27.5-year property, but you're using a mid-month convention. So this can be spread out over either 28 or 29 years, depending on which month that property was placed in service. So now let's talk about a Section 179 deduction. Remember when I said, if you buy an asset, it's greater than 12 months, you cannot deduct the entire cost in the year that you purchased it. You have to spread it out over time, and that's called depreciation. But I said there were exceptions. And so now we're going to talk about a couple of exceptions. The first of those is a Section 179 deduction. So this is a special deduction that allows a business to expense the entire cost of an asset in the year it was placed in service, rather than depreciating it over its normal recovery period. So this is a good thing. It gives us an immediate deduction, lowers our taxes immediately, and we like that. Now, in order for this to work, to be eligible, the property itself has to be eligible. It can be either new or used, so it doesn't have to be something you're buying brand new. It must be purchased, not produced yourself. You have to have purchased it, and not from a related party. So they don't want people playing games with getting big 179 deductions by selling assets back and forth between related parties. So you have to have purchased it, but not from a related party. And it must be used more than 50% for business. So it doesn't have to be used 100% for business, but it has to be used more than 50% for business. And of course, you only get to deduct the business portion. So if you have an asset that's used 60% for business, 40% for personal, you only get to deduct 60% of the cost of the asset, not the whole 100%. Qualifying property. So not all property is qualified, but qualifying property for a 179 deduction tangible personal property, such as machinery and equipment, vehicles, etc., and qualified real property. So this is certain qualified improvement property, they call it. Certain non-residential real property improvements placed in service after the real property was placed in service. So remember, we talked about that before. You add to the basis of an item if you're putting on a new roof or a new air conditioning system, etc. So if the item that you are adding on or improving is on the list that's included in this, and it is for non-residential real property. So this does not work for like a residential home that you are renting out. It has to be non-residential real property. Other qualifying property is single-purpose agricultural or horticultural structures, off-the-shelf computer software. In other words, not software that you created yourself, but you went out and bought it. You can use the 179 deduction for, and then there are other specialized assets. For the exam, you do not need to know all the nuances of this. Just know kind of the big buckets: tangible personal property, qualified real property, single purpose agricultural, off the shelf computer software, and then there's other specialized assets, but they're not going to get that detailed on you on the exam. There are limitations on the 179 deduction. So for 2023, the most you can do when you add up all of this is $1,160,000 worth of property that you can deduct immediately using Section 179. If you have a sport utility vehicle, then the limit for that one item is $28,900. And there is also an investment limit. And the purpose of this is to eliminate very large companies from getting this benefit. So this is designed for small and medium-sized companies, not for large, like Fortune 500 companies. So what they say is, if the cost of all of your Section 179 property placed in service during the year exceeds $2,890,000, and that amount goes up every year with inflation, but for 2023, $2,890,000, then the available deduction, this $1,160,000, is reduced by the excess, but not below zero. In other words, if you had $3.5 million worth of Section 179 placed in service during the year, you would not be able to deduct the full $1,160,000. You'd have to deduct, let's say 3.5 minus this is about 2.9 million, so $610,000. You'd have to reduce this $1,160,000 by $610,000. So your limit for the year would only be about $500,000, whatever the exact number is. So that's what it means. Any amount over $2,890,000 reduces this $1,160,000. So obviously, if you get up to over 4 point something million dollars, then you're not going to get any Section 179 deduction for that year. There is also a business income limitation, and that is that the 179 deduction cannot exceed the taxpayer's business income. So it cannot create a loss. So this is a real limitation. If you got a business like a startup company that's not making money, they're losing money, they're not going to be able to take this Section 179 deduction. So the next special depreciation deduction we're going to talk about is called the special depreciation allowance, or usually we call it bonus depreciation. And so what this says, for 2023, you can elect to expense 80% of the cost of qualified property and depreciate the other 20%. So you don't get to deduct the whole thing, but you get to deduct 80% of it, and then you set the other 20% up as an asset, and then you depreciate it over whatever its recovery period is. Before 2023, so for the last couple of years before 2023, this was 100%. So you could deduct 100% of it. But in 2023 is the first year it decreased. It went down to 80%. And then for 2024, I believe it's going to 60% and then 40%. So unless Congress comes in and changes it, it's going to keep going down to eventually it goes away altogether. But for 2023, which is what you need to know for the exam, you can elect to expense 80% of the cost and depreciate the other 20%. There are no annual limits or investment limits, which means even big companies can use this. It can create a loss, so you don't have to worry about that. The property can be new or used, purchased, or produced. And it applies to tangible property with a class life of 20 years or less or off-the-shelf software. So when this was 100%, this was definitely a better deal than Section 179 because you still got to deduct the whole cost, but you didn't have to worry about any of the limits. So we would just have clients use the bonus depreciation instead of using Section 179. Now that it's gone down to 80%, in the future years, it's going to go even lower, then you have to look at the two. And 179 is probably a better deal as long as you qualify because you get to deduct the whole thing. But if you don't qualify for 179 or only part of what you purchase qualifies, then you can switch to this bonus depreciation and get this 80% deduction in the current year. Amortization. This is where you deduct the cost of intangible assets over their recovery period. It uses straight line only, and it's based on months. So when you see amortization, you'll usually see it in the terms of the number of months. And when we compute it, we just always use months. So you look at what month it was purchased, you get a certain number of months. And so you just use how many other months you had in that year. And that's how much you depreciate it on a straight line basis. So some of the types of assets, you've got Section 197 intangibles, and that's a list of different types of intangibles that we'll get into on the next slide. You've got software development and actually other software as well. Organizational costs, startup costs, and loan fees. So we will talk about each of those. There can be others as well, but these are the major categories that you need to know about. So first, Section 197 intangibles. These are, when they are purchased or acquired, they are amortizable over 180 months. And the reason I say when they are purchased or acquired is because if it is something you produce yourself, it is not a Section 197 intangible and you cannot amortize it. So these are things that are purchased or acquired and you amortize them over 180 months, again, using straight line. So some examples of 197 intangibles: goodwill and going concern value. This has to do with when you buy a business, you often pay more for the business than just the value of the physical, tangible assets because the business often will have a value because it's got a good name in the market. It's got a brand name that people recognize. They've got a customer list. And so you've got a ready-made group of customers that you can go out and sell to. So these types of things are called goodwill, or sometimes going concern value. They're very closely related to each other. So that's an idea of an intangible. But again, it only comes up when a business is acquired. So if you start up a business and you never sell it, you're never going to have goodwill or going concern value on your books. It only happens from an acquisition. Other examples are patents, copyrights, trademarks, licenses, and permits. It could be that getting a license in a particular business is very difficult to do. And so having that license already can be valuable. So that would be an intangible that has value. And customer list and relationships would be included, again, similar to goodwill and going concern value. Let's talk specifically about software. If your business develops software, so you've got coders and they're developing software and apps, etc., those expenditures must be capitalized and amortized over 5 years. So instead of getting to deduct all of the salary that you paid to those software coders and developers, you have to actually capitalize part or all, depending on what they're working on, of those expenditures. And then you amortize those costs over 5 years or 60 months. If the software is developed outside of the United States, then it's amortized over 15 years. So they're trying to encourage people to use US-based developers to develop the software because you can deduct it sooner, deduct over 5 years instead of 15 years. Any off-the-shelf software that you purchase is amortized over 36 months. And as we talked about before, you can also use Section 179 or bonus depreciation for those. But if you have any that you need to amortize, it's done over 3 years, 36 months. Any software that's included in the purchase of a computer is depreciated with the computer. So you don't need to separate out. If you buy a PC and it's got Windows on it and some other programs on it, you don't have to separate out how much of it was the hardware and how much of it was the software. You can just put it all together and depreciate that over the computer's recovery period, which is 5 years. Any software that is not available to the general public that's acquired in connection with the purchase of a business is a 197 intangible, and that would be 180 months. So if a company has developed their own proprietary software in-house that they use in their business and somebody comes along and buys that business, then that software would be an intangible set up on the acquiring company's books and amortized over the 180 months. Next are organizational and startup costs. These are two different things that can potentially be deducted or amortized. So organizational costs are the costs to create a corporation, LLC, or partnership business. It can include attorney's fees, state incorporation or organization fees, accounting services, etc. So if you pay an attorney to set up one of these businesses, that is considered an organizational cost along with whatever fees you had to pay. Startup costs are a little different. These are amounts paid or incurred for creating or investigating the purchase of a business. They are incurred before the business begins. So this can include market research, surveys, advertisements before opening, travel costs, salaries before opening, consultant fees, etc. So anything that the business owner did before the business was actually open is considered a startup cost. They are both considered capital assets rather than expenses, which means they generally must be amortized rather than deducted currently. However, I think I kind of mentioned before, you might be able to deduct these, so that's what we will talk about next. Up to $5,000 of organizational costs can be deducted if you had $50,000 or less of such costs. So as long as you had $50,000 or less of organizational costs, you can deduct up to $5,000 of those currently, and any remainder you would amortize. So here we have this example. If total organizational costs exceed $50,000, any amount over $50,000 reduces the $5,000 deduction limit dollar for dollar. So for example, if you have $52,000 of organizational costs, you can deduct $3,000 currently. So you have to take the $5,000 and reduce it by the amount over $50,000, which was $2,000. So you can deduct $3,000 currently. And then the same rules apply for startup costs. You can deduct $5,000 in the year the business begins. So you incurred the costs prior to the business beginning, which could have been in a prior tax year. That's okay. You can deduct $5,000 of those costs in the year the business begins, and the $50,000 rule applies just as with organizational costs. So it's the same rule. Any costs that are above the deductible amount must be capitalized and amortized over 180 months. Loan fees. So this typically comes up when you are borrowing money or a business is borrowing money to purchase real property. The loan-related fees and costs are not included in the basis of the property, as we said before. Instead, they are capitalized separately. So capitalized means being put on the balance sheet of an asset, meaning you cannot deduct them all currently. So instead, what you do is you deduct those over the life of the loan. They are amortized over the life of the loan. So if it's a 20-year loan, the loan fees are amortized over 240 months. So that's the way loan fees work when you are buying property. Next is depletion. Depletion is the using up of natural resources extracted from a mineral property by mining, drilling, quarrying stone, getting stone out of the ground, or cutting timber. That's what depletion is. It is a similar concept to depreciation. It allows the business to deduct the cost of the property over time. There are two methods of depletion. There's cost depletion and percentage depletion. For standing timber, you must use cost depletion. For anything else, whether it is minerals, oil and gas, etc., you can choose to use either cost or percentage of depletion. depending on which one results in the higher deduction. So we do want to remember for the exam, two different kinds, cost and percentage, and that timber must use cost. I'm going to briefly explain them and give you examples. You should not expect that you're going to get into a deep problem with lots of numbers on the exam. You just want to understand the basics of depletion. So I just want to give you enough to understand it. Cost depletion. So it allocates the cost of the property over the anticipated number of units to be extracted over its useful life. Then each year you multiply the calculated cost per unit times the quantity extracted. So, for example, a business pays $1 million for forest land. They expect to harvest 200,000 trees eventually. Over time, they're going to extract 200,000 trees. So the cost per unit is $5. It's $1 million cost over 200,000 trees. If in year one they harvest 10,000 trees, then the depletion deduction would be $50,000, which is 10,000 trees times the per unit cost of $5. So that is cost depletion. It is based on the cost of the property. Now we get to percentage depletion. Here you multiply the gross income. So this is not based on the cost of the property. It is based on the income that the property produces each year. So you multiply the gross income from the property by the applicable depletion percentage. These percentages are provided by the IRS and range from 5% to 22%, depending on the resource being extracted. If you want to know, you can find it in the IRS publication, but you're not going to be asked or expect to know on the exam that a particular type of mineral has a particular percentage. You just need to know there is a range from 5% to 22%. So, for example, gross income from the property in year one is $200,000, and the IRS table depletion percentage is 10%. So therefore, the depletion deduction is $200,000 times 10% or $20,000. So that is percentage depletion. Moving on now to the sale or disposition of assets. When a business asset is sold or otherwise disposed of, there will generally be a gain or loss recognized on that disposition. And all you do is you compare the sales price to the adjusted basis of the asset, and the result is the gain or loss. Now, the gain or loss can be either capital or ordinary, depending on the circumstances. And this is reported on Form 4797. And so this is what the 4797 looks like. So you would report description of the property, when you acquired it, when you sold it, the gross sales price, how much depreciation has already been taken or could have been taken over the time, the cost or other basis plus improvements of the property, and then from that you compute the gain or loss on the disposition of that property. There are various types of asset dispositions. Sale is the most common. You simply sell an asset. That's what we're going to focus mostly on in this video. You could also have an exchange. We'll talk about that very briefly. You could abandon the property, just stop using it, abandon it, throw it away, whatever. It could be foreclosed on or repossessed. Could be an involuntary conversion, could be stolen, or it could be destroyed. We talked about many of these things in part 1, video 3. So I'm not going to go into detail on most of them. We're going to talk mostly about sales, a little bit about exchanges, and then we can rely on the other video from part 1 to handle the rest of these. The same general concepts will apply. And in part 2 of the exam, we're mostly going to be dealing with sales of property, not these other items. Capital versus non-capital assets. So this is going to be a brief recap from that part 1 video. Just to remember, non-capital assets. There are specific categories of assets that do not result in a capital gain or loss upon sale or disposal. So any gain or loss is considered ordinary gain or loss. So it's a specific category of assets that are not considered capital assets that we will go over on the next slide. A capital asset, then, is any asset that is not considered non-capital. So it's not on that list, then it is a capital asset. And this results in a capital gain or loss upon the sale or disposal of that asset. Why is that important? Because long-term capital gains are taxed at a lower tax rate than ordinary gains. Therefore, we generally prefer capital gains. But if you have a capital loss, those losses are limited, but ordinary losses are not limited. Therefore, we would generally prefer ordinary losses. So taxpayers prefer capital gains and ordinary losses. Keep that in mind. It's going to be important as we move through this material. So what's that list of things that are not a capital asset? Again, this is the same list from that part 1, video 3. Property held for sale to customers, inventory, depreciable property used in a trade or business, real property used in a trade or business, and it's broken out separately because some real property is depreciable and falls into this category, but some real property, land, is not depreciable, and so they're saying land is also not a capital asset if it is used in a trade or business. Intellectual property, patent, copyright, etc., held by the person who created it. If you purchase it, that's different. But if it's by the person who created it, then it is not a capital asset. Accounts receivable in a business, not a capital asset. Certain U.S. government publications, certain commodities, derivative instruments held by dealers, hedging transactions, and supplies used in a trade or business. So you'll notice a big theme of this is essentially no asset that is used in a business is a capital asset because they're all on this list somehow. Any property held for sale to customers, depreciable or real property used in a trade or business, accounts receivable, supplies. There's not very many other types of assets that are used in a trade or business that are not going to be on this list. So business property in general, not a capital asset. Capital versus ordinary. So we said already that capital gains are taxed at preferential rates for individuals. So this affects sole proprietorships, partnerships, S corps, since the capital gains and losses are passed through the owners in that case. C corps, though, pay the same rate, 21%, on capital gains as on ordinary income. So this distinction is not as important for them, at least if you have a gain. They're going to pay 21% regardless. Capital losses can only be used to offset capital gains, except individual taxpayers can take up to $3,000 of net long-term capital losses. So in other words, as we said before, capital losses are limited. You can use them to offset capital gains, but beyond that, individuals can only take an additional $3,000 each year of net long-term capital losses. C corps cannot even take the $3,000 loss, but they are allowed to carry back capital losses 3 years, and they can carry capital losses forward 5 years as short-term capital losses. And let's revisit for individuals what those capital gains rates are. So again, it depends on your filing status and then how much taxable income you have. But the capital gains rates are 0%, 15%, or 20%. That's the maximum. Ordinary individual tax rates can range from 10% to 37%. So you can get a significant savings by having it be a capital gain rather than an ordinary gain if you are an individual taxpayer. Now, there are a few exceptions to this. If you are selling collectibles, then those are taxed at ordinary rates, though to a maximum of 28%. So even if you're in the 37% tax bracket, you would only pay 28%, but you don't get the benefit of this. The taxable part of a sale of Section 1202 qualified small business stock is taxed at a maximum of 28% as well. So remember, the 1202 is where you can exclude up to $10 million of gain on the sale of certain small business stock. Well, you might have more gain than you can exclude. And so in that case, the taxable portion is taxed at your normal tax rates up to a maximum of 28%. And then this portion of unrecaptured Section 1250 gain is taxed at the maximum 25% tax rate. And we will actually talk about that a little bit more in this video. So capital versus ordinary. Ordinary gains are taxed at ordinary tax rates. Ordinary losses can offset ordinary income. As a result, taxpayers usually want capital gains and ordinary losses. And the tax law actually allows for just this scenario for dispositions of certain business property. If you have been paying attention, there might be a big question in your mind right now, because this slide is saying that in certain scenarios, you could have business property that allows for capital gains and ordinary losses. Yet, just a little bit ago, we were looking at a list of things that are not considered capital assets. And what was prominent on that list? Business assets. Assets used in business are not capital assets. So you might be wondering, how in the world could there be a capital gain for a non-capital asset? Well, I'm glad you asked. And so what that does is it brings us to something called Section 1231. First, we need to understand Section 1245 and Section 1250 property. Section 1245 property is depreciable personal property, so not real property. There's a couple of exceptions for grain silos and oil and gas storage structures that I guess technically are real property, but they're still considered Section 1245 property. But in everyday parlance, Section 1245 property is depreciable personal property. That's what Section 1245 property is. Section 1250 property then is depreciable real property. So if you've got buildings, for instance, or improvements to buildings, etc., if it's depreciable real property, then it is Section 1250 property. So again, land would not be included because it's not depreciable. So 1245 is depreciable personal property. Section 1250 is depreciable real property. Then we also have something called Section 1231 property, which is any depreciable tangible property. In other words, not inventory or intangibles, because inventory is not depreciable and intangibles are not tangible. So it doesn't include those. So any depreciable tangible property used in a trade or business and held for more than 1 year. So in other words, if you have Section 1245 property or Section 1250 property used in a trade or business and it has been held for more than 1 year, it is also Section 1231 property. So it's not that it becomes Section 1231 property instead of being Section 1245 or Section 1250 property. It fits into both categories. Any of this property, if it's Section 1245 property and it's held for more than a year, it is also Section 1231 property. If it's Section 1250 property held for more than 1 year, it is also Section 1231 property. So what is so special about Section 1231 property? The sale, exchange, or involuntary conversion of Section 1231 property results in the best of both worlds. You get capital gains and ordinary losses. So even though these are not capital assets, we saw the list, they're not capital assets, still, if you have a gain, you get capital gain treatment. And if you have a loss, you get ordinary loss treatment. So that's awesome. So you look at the total of all the Section 1231 gains and losses, and if it results in a net gain, then it's all treated as capital gain. If it results in a net loss, then it is all treated as an ordinary loss. So that's the good news. Of course, it's not always going to be good news. So it could be that some of your gains don't actually get to be treated as capital gains. So that's what we're going to talk to here. We got two concepts that can convert part of that 1231 gain to be ordinary rather than capital. So the first concept is the 5-year look-back rule. So if in your 5 preceding tax years you had cumulative net Section 1231 losses, but you had a net 1231 gain in the current year, then the current year gain is ordinary to the extent of your prior cumulative losses. So let's look at an example. In 2023, let's say you had a $2,000 net Section 1231 gain. In 2020, you had a $2,500 loss of 1231 property. 2022, you had a $1,800 1231 gain. And then in the other 3 years, you had no Section 1231 gains or losses. So now we'll look at that here on a little chart. So this is what you had in each year. 3 of the years you didn't have anything. 2020 you had a $2,500 loss. 2022 had an $1,800 gain from Section 1231 disposals. That means your net loss over the last 5 years is $700. So now this year you have a $2,000 1231 gain. You're going to have to treat the first $700 of that as ordinary. So that is ordinary gain for this year. The remaining $1,300 will get that special long-term capital gain treatment. What they're saying here is, since you got this benefit in previous years of getting an ordinary loss, and now you have a gain, we're going to make you treat the gain to the extent of those prior losses. We're going to make you treat this year's gain as ordinary. The next one that could cause some of your 1231 gains to be ordinary is depreciation recapture. And we did talk a little bit about depreciation recapture in part 1, but we're going to get more specific here. If you dispose of depreciable or amortizable property at a gain, you may have to treat all or part of that gain, even if it's otherwise non-taxable, as ordinary income. So for Section 1245 property, because the rules are a little different between 1245 and 1250 property. So for Section 1245 properties, remember that's personal property, to the extent that depreciation deductions were taken or could have been taken, even if you didn't take them, on 1245 property, any gain on the sale of that property is ordinary gain. Any gain in excess of previous depreciation is capital gain. So if the amount of your gain is greater than the amount of depreciation that you've already taken, then some of your gain is going to be ordinary and some of it is going to be capital. For Section 1250 property, it's a little bit different. The depreciation recapture is limited to the portion of the depreciation in excess of straight line depreciation. So let's look at another chart here, and it shows you 1245 property and 1250 property. For ordinary gain, gain on sale is ordinary income to the extent of depreciation allowed or allowable. Any gain remaining after subtracting this recapture is capital gain. So you could have some ordinary and some capital. And I'm going to give you a couple of examples here after this so we can make it a little bit more concrete. For Section 1250 property or real property, gain on sale is ordinary income to the extent depreciation allowed or allowable exceeds straight line. So if you used one of those accelerated methods, 150%, 200% depreciation, then the amount of that depreciation that exceeds what straight line depreciation would have been will be treated as ordinary gain. The gain from the straight line depreciation itself is capital gain, tax capped at 25%. So this, remember on that chart when we talked about this special at the bottom, we talked about the special Section 1250 depreciation recapture. This is what we're talking about. So if you have gain from straight line depreciation, then it is considered capital gain. However, it is taxed at ordinary tax rates up to this maximum of 25%. Any gain in excess of the gain from the straight line depreciation is regular capital gain, so the maximum is 20% that you would have to pay. It'd be 0, 15, or 20%, depending on your taxable income for the year. So let's look at an example of each, one for 1245 property and one for 1250 property. JL Widgets, LLC, purchased equipment several years ago for $20,000. Since then, JL has deducted $9,000 of depreciation on the equipment, making its adjusted basis $11,000. In 2023, JL sold the equipment for $23,000. So the gain on the sale is $12,000, right? $23,000 minus the adjusted basis of $11,000. Of that gain, 9,000 is ordinary and 3,000 is capital. So they took $9,000 of depreciation, which means they got an ordinary deduction for that depreciation. So therefore, $9,000 of their gain is going to be considered ordinary. They are said to have to recapture that depreciation deduction that they took. The remainder then is capital gain. Now, if their gain had been less than $9,000, then it all would have been considered ordinary income. But since they had more gain than their previous depreciation, they do get to treat the excess as capital gain. Section 1250 property. JL Widgets LLC purchased a warehouse in 2011 for $200,000. Since then, JL has deducted maker's straight line depreciation of $59,000, making its adjusted basis $141,000. In 2023, JL sold the warehouse for $350,000. So the gain on the sale is $209,000, the $350,000 sale price minus the $141,000 adjusted basis, right? Because they had the $200,000 minus $59,000 gave you the $141,000. Of that gain, $59,000, which was their straight line depreciation, is taxed at a maximum 25% tax rate. So that's their unrecaptured Section 1250 gain. The remaining $150,000 is regular capital gain. So it's taxed at 0, 15, or 20%, depending on taxable income. So in this case, they didn't have any of the accelerated depreciation, and most Section 1250 property that you're going to deal with is on a straight line basis, so you're not going to have accelerated depreciation. If they had some accelerated depreciation, then to the extent that accelerated depreciation exceeded straight line depreciation, they would have had just ordinary income. They wouldn't have gotten any tax benefit at all on that piece of it. Like-kind exchanges, we dealt with this in part 1, video 3, but I just want to recap it again. If you trade business or investment real property solely for other business or investment real property of a like kind, you do not pay tax on any gain or deduct any loss from the trade. This is called a Section 1031 exchange, and you report it on Form 8824 and on Schedule D. So this is a good deal. If you do this like-kind exchange, you don't have any gain that you need to recognize. Now, it is only on real property. There was a time when you could do it on certain types of personal property as well, but it is now only on real property. In order to do this like-kind exchange and have it be tax-free, you have to meet all 6 of these conditions. It has to be business or investment property. The property traded and received must be real property, as we said. It must be like kind, but any real estate is considered like kind as long as they are both in the United States. So that makes it kind of easy. The property must not be held for resale. So in other words, you're not a home builder who is going to resell these lots. It's not inventory for you, in other words. The property to be received must be identified within 45 days after the date you transfer the property given up. In other words, you don't have to know exactly what property you are trading it for when you actually make the trade. You can decide, maybe whoever you're trading with has got several different pieces of property and you're not sure exactly which one you're going to agree to. Well, you've got 45 days from the time you transfer the property that you gave up in order to identify the property that you are going to get in exchange. The property received must then be received, so you don't have to receive that property within 45 days, you just have to identify it. But it must be received by the earlier of the 180th day after the date you transfer the property given up, so that's about 6 months, a little less than 6 months, it's 180 days. So 180 days from the date you transfer it, or the due date, including extensions for your tax return for the year in which the transfer of the property given up occurs. So if you're talking about a calendar year here, and let's say you've got an S Corp The due date for the S Corp return is March 15th. You can extend that to 6 months to September 15th. So you would have up to September 15th of the following year. So it would be the earlier of those two, 180 days after the date you transfer the property, or the due date, including extensions for your tax return for that year. You can have an exchange that is partially taxable and partially non-taxable. And that would happen if you receive money or not like kind property. So maybe you receive some personal property in addition to the real property. In addition to the like kind property, and that is called boot. So when you receive money or not like kind property, that is called boot. You do pay tax on the gain up to the amount of that boot. So it's the amount of the cash and the fair market value of the not like kind property. You do pay tax on that, but then the rest would be tax free. If, on the other hand, you pay money or give up other type of boot, in addition to giving up like kind property, as long as those other 6 conditions are met, then it still counts as a non-taxable trade for you. So the other party would have to include part of it in their income, but you do not, since you're the one who are paying the boot rather than receiving the boot. So that is our recap of business assets and depreciation. I appreciate you joining me, and I will see you on video 4.